Hey, welcome back to the Monk Investor. If you truly like what you're watching, if you could give it a thumbs up and subscribe and like, I would greatly appreciate it. Last episode, Bear Season Episode 3, we talked about inverse correlations. Well, in Episode 4, we pick right back up where we left off. Let's start with SPY. When would you not play inverse correlations? Friday was a perfect example. It closed at negative 0.71. You need for it to be heavy on either side. So that means that if it's heavy going up or it's heavy going down, that's a perfect opportunity. When it's stagnant or trading sideways, that's when you just sit back and you just chill. You don't need to be in the market. The fundamentals apply to every aspect. If you're someone who's a value investor, which that means you buy stocks, you don't day trade, you don't swing trade, holding SPY for over a year would have collected you $108.35. That's a 31.98% increase, and that was with a pandemic. So holding long term in stocks is a form of defense because time always wins out. As they say, time in the market is worth more than timing the market. So defensive tactics can apply to everything. We talked about the VIX, which VXX is an ETN, exchange traded note. When would you not play it? Last Friday was a perfect example. It barely moved, and it was in the red. But if you look at VXX over the past year, you would not want to play it. It's negative 74.66. That means that long term, this is not a good play. So you only play this in short increments. You play it 1 week, 2 week, maybe 2 months max. And you play it during times when the stock market's down. You don't play it when it's up. During the Great Depression, if this existed, you would have been rich. VXXX. VXXX. It's been a lifesaver for a lot of people. You just have to time it and know when to play it. So let's look at what happened with the VIX or VXX during COVID-19, March 16th, up $131. So that means that it likes volatility. So you need a mindset change. You need to get in the habit of using it. 242.20 VXX. That's how much it went up. So that means that it loves volatility. Let's take a look at the S&P 500 last Friday. 44.32. It was down negative 40.76 points, which is almost a whole percent. That was just last Friday. So that means that the S&P 500, the stock market was down. It was in red. It was in shambles. Well, there's other ways to profit from that. If you're a long-term investor, you could have went a different route. You could have played VXXX because VIX was up while it was down. And the reason I point these things out to you guys because I want you to always get into the mindset that there's an opposite for everything. Just like yin and yang, there's an opposite. That's called an inverse correlation or dichotomy, however way you want to put it. So if you're a long-term investor, the market's going up more times than it's going down. This is the past 5 years of the S&P 500. So it's in the green, which makes it very stupidish to bet against the market all the time. You do it in short increments. If you look during the COVID-19, March 16th, it went down very significantly, but it was up afterwards. So there's opportunity in bad moments. You just have to know how to play it. Bear season is more to it than the surface. Bear season just isn't about numbers. It's not about investing. If you thought bear season was about investments, you're dead wrong. It's about life. How does this relate to life? Because you have to deal with the good and the bad. Whether things are green, whether things are red, it just means that you have to find a way to deal with it. Using inverse correlations or dichotomies, you have to know what you're doing. I've been homeless. I've seen the top. I've seen the bottom. And the one thing that remained constant was me. So many of these examples I've given you isn't just investment related. It's about life. And I hope you can appreciate what I've taught you and what I've tried to implement.